All right, so we've just finished going over the exam solution, and we'll begin with a couple of announcements. First of all, that homework 11 is going to be due a week from today. And so that's available now on Blackboard. Let me just very briefly show you what it looks like. There are 6 questions on homework number 11, and the first couple of questions, question 1 and 2, tie into directly the in-class exercise that we're going to be going through in today's class meeting. So you should be able to get an early start on homework 11 if you want to just dive right in based on what you learn in today's class. So homework 11 is due a week from today, and then on Friday the 17th is when your project report is due. And just as a reminder, that report is worth 9% of your course grade, so it can really be the factor that boosts you up over the finish line to where you want to get, or if you neglect the project, then unfortunately it could drag your grade down a little bit. So I encourage you to read over the assignment description in real detail, and I sent you previously a link that's describing the lecture that shows where you can find when that was introduced. And in fact, I think that the link is available in Blackboard if you want to go directly to that class meeting where I introduced the project. Alright, so those are the announcements for today. What we're going to be doing today is going over some new topics: price, demand, and break even. And this is going to be familiar to some of you who maybe have taken an economics class before, but it's really useful for engineers because we're in the business of making things and adding to the market, and so it helps for us to have an understanding of the relationship between price and demand. Alright, so on screen is something that comes around every year about Thanksgiving time. A lot of families have the tradition that you'd go and buy a newspaper on Thanksgiving and kind of look through all the ads that are available. And while someone is cooking, the rest of you are kind of planning out what you're going to do for Black Friday, and all the amazing deals that are available, and how you can get a tablet computer for $28 or a flat screen for $149, or you're going to save a bundle on a toaster oven, that sort of thing. And of course, low prices like this definitely have an effect. That's why they take the time to publish the ads and set the low prices, is because it gets people in line. There is a relationship between low prices and demand. And so what we're looking at is price versus demand relationship. And of course, this is a picture. You can see all these people in a line. This isn't any ordinary day at Best Buy. Trust me, people don't line up in front of Best Buy in the middle of the night. You can see that it's dark, the moon's out, people are in line to go shopping. It's just because it's a special occasion. It's not every day. And so it's this rare occasion when the prices are especially low that stimulates that demand. And of course, the flip side of that is occasionally there are situations where demand dries up. And you may have already been acquainted with the fact that Toys R Us recently went bankrupt. And there was a Toys R Us location near the Huntington Mall in Barbersville, and that location has since been repurposed to like some sort of a trampoline, an indoor trampoline park, because Toys R Us couldn't compete with Amazon. Amazon was undercutting them because Amazon has lower costs having to do with, they don't have a showroom for the toys to you to walk through the store. And so if Amazon doesn't have to pay to heat the store and doesn't have to pay to staff the store, and all they have to do is operate a warehouse and shipping operation, then they can undercut prices. And that's particularly when they don't collect sales tax for so many years. And so Amazon was able to undercut the prices that Toys R Us could charge, and there wasn't as much demand for Toys R Us. So what we're talking about today is the relationship between price and demand. And in this relationship of price versus demand, we think of price as an independent variable, meaning that's what we have control over. As a manufacturer or a seller, we can choose what we want to charge for the item that's being sold. Demand, on the other hand, is a dependent variable. And what that means is that it's responding to the price and changes in price. And so you can't directly as a manufacturer force people to buy your product. You can only entice them to purchase the thing that you're producing by setting an attractive price. So in this relationship, the price, if it increases, we know that demand will decrease. But if you have an item that you're trying to sell and you decrease the price, then the general relationship is that demand will increase. And if we graph that relationship, here's a typical expression for what the price versus demand relationship looks like. Now, in this case, the blue line is linear. It's not usually a linear relationship between price and demand, but this is just a simplistic kind of a conceptual relationship. And so what this is showing is that when you have a low demand, that may be because the price is high. And so if you set your price high, then there's going to be less demand than if the price is low, then the demand increases. And so take as an example Tesla. They had the Model S, which was an expensive car, like $90,000 for a Model S. And it was a fantastic car, but you didn't see as many of those on the road as you do now with the Model 3, which has a much lower price, and so there's a lot larger demand for that electric car, for the Model 3, because it's more affordable. Instead of $90,000, you can get a Model 3 for maybe around $40,000. And so the typical relationship here is that as the price increases, the demand is lower, but if you lower the price, the demand increases. So there's an equation that relates these relationships, and what we have is price is equal to A, where A is the intercept. If you extend this line and intercept with the vertical axis of price, A is what price would cause it so that nobody buys any if there's zero demand. And so, you know, at $90,000 they still were able to get some people to buy the Model S. But what if they were charging $250,000 or $500,000? There's some price at which no one would buy that item. And sometimes we can maybe think that it's a theoretical thing, but in this method we say A is the price where the demand is zero. So that's the intercept with the line. Now B is the slope of the line. So B is the slope of this blue line, and it's how much the demand increases for every unit decrease in price. So if you decrease the price of the thing you're selling by $1, how many additional units are being sold because of that reduction in price? That's B, the slope of the line, and then D is the demand itself. And so that's how we can relate the price and demand, is with these two other variables, the intercept and then the slope of the line. So revenue, then, if we have some idea of what the demand is the number of units that you're selling, and price is how much you're charging for what's being sold. So revenue, the income that you get for selling your item, is the number of units you've sold multiplied by the price for each of the units. So revenue is the purchase price multiplied by the number of units sold. That's revenue. Now we can substitute this revenue expression. If we take the total revenue, so revenue is price times demand, we can substitute in the price equation into here and then distribute that through. So one of the ways that you could calculate revenue is by having it just be a function of demand, the intercept of the line, and the slope of the line. So total revenue is price times demand, where price is known based on this equation. This is a really important figure, and you may remember that I've mentioned before I like to include an image on exams and then ask students to explain the image. I think that's a really valuable way to assess what people know, is to ask them to describe the concept behind an image. And so that's kind of a warning that this is an important one, and I like asking test questions where you need to explain a figure. So this figure is showing how much revenue can be earned as a function of the number of units being sold. So let's look at the extremes. At the extreme down here, we don't have much revenue because the demand is so low. And that makes sense. If we know that revenue is the price per unit multiplied by the number of units sold, why is it that our demand is so low at this edge? It's because we have a high price. And so the way that we increase the demand is by lowering the price. Now, even though you're lowering the price, you're still getting more revenue because you're selling a lot more units. But then we get to a point where the demand is getting higher, but the revenue is decreasing. So why is it that you're selling more units, but the money coming to your company is less? Well, the reason why you continue to sell more units but your revenue is less is because in order to stimulate that extra demand, you've had to lower your prices so much that now, even though you're selling more, the price is so low that your revenue is decreasing. So that's kind of what's happening with this curve, is that we can identify what's called here the D hat. That is the maximum revenue. That's the amount of demand that generates maximum revenue. So we see that it's using the relationship A, which was the intercept of the price versus demand curve. So A was the vertical intercept, where it's the price that causes there to be no demand. So that's A divided by 2 times B, where B was the slope of that price curve. So D hat is how you can calculate what is the amount of units that maximizes your revenue. Now here's the thing to keep in mind though. Companies don't exist to maximize revenue. What do companies exist to maximize? Does anybody remember, if we think about the point of a company, we're not talking about public service projects, but we're talking about a company that is in business to make money. Revenue is good, but profits are better. And so D hat that's on the screen there, maximum revenue, may not correspond to the point that generates maximum profits. In order to understand profits, we have to take a look at cost. So there's 2 types of costs. There's the fixed costs and variable costs. And just broadly speaking, fixed costs are the things that you have to pay for regardless of how many units are being generated or sold. So if you own a piece of equipment and you have to pay for that equipment whether or not you use it, you could consider that a fixed cost. Or another example of a fixed cost might be if your factory is in a warehouse, you have to pay for the warehouse and you have to pay rent on the land, regardless of whether you make 1 unit or whether you make 1,000,000 units per month. There are certain costs that don't change based on how many things are being produced. But then the variable costs, those are the costs that are affected by your level of productivity. So the raw materials for what's being generated, or the packaging or transportation costs, or the cost of your hourly employees, all of those things are variable cost. And so if you're only making 1 unit, you wouldn't have very much variable cost. But if you're making 1,000,000 units, now you have to pay a lot more wages, a lot more materials, and so on. So total cost is the combination of those 2 things. Now the variable cost can be broken up further into the variable cost per unit, which is how many materials go into generating just 1 item. So the lowercase v variable cost per unit, you could think of, like for example, you've maybe seen teardowns that they've done before of cell phones, and they're telling you, in a cell phone, how much is the cost of the screen, how much is the cost of the processor and the RAM and the plastic. So if you're looking at the individual components, you can come up with the variable cost per unit, meaning just of the one thing that's being produced. Profit is revenue minus the costs. And so the income that's coming in minus what you spent to generate those items. The difference between the two is your profits. And so a company wants to maximize its profits. And the way you do that is by having big revenue and small costs. So companies are always looking for ways to cut costs, because if you cut costs, then that's going to increase your profits. So optimal demand is what a company is actually aiming for. D hat, remember from the previous screen, D hat was the formula that gives you maximum revenue, but there's a different formula that gives you maximum profit. This D star is the formula for optimal demand, which is how many units should be sold in order to maximize the profit. So A was the intercept, the vertical intercept, which is the purchase price at which point no one is buying any. That was lowercase a. Lowercase v is the variable cost per unit, and then you divide that by 2 times b, where b was the slope of the line. That's how much additional demand there is for each dollar decrease in price. That's b. Now, break-even points, this is the formula for it, but it's easiest to explain it once I put a figure on screen that combines the costs and the revenue together. So know that there's this formula, and let's jump ahead and look at what are break-even points. So here is a figure, and we've seen the revenue curve before. Remember that I already showed you this parabolic curve, which is our revenue. So, at the one extreme you have low revenue when you're not generating very much demand because the prices are so high. That means you're not selling many units. So even though you have a high asking cost for the item, since you're selling so few units, the revenue is low. So we've talked about that blue parabolic curve before. Now let's look at these other two curves. There's the fixed costs. C sub f is the fixed cost, and C sub t is the total cost. And so then the difference between the fixed and the total cost is the variable cost. And so C sub v is the variable cost. And so if you have a very low demand, you'll notice that C sub v would be small, because if you're not selling very many units, then the variable cost associated with that level of production will be relatively minor. Whereas if you have a high demand, then your variable costs are going to be much larger, which takes the total cost further away from the fixed. So what a company is trying to do is maximize profit. And so the first point at which you're profitable is D prime 1. That's a break-even point. It's the first time that your revenue is above the total cost curve. What if you're to the left of that? What if you're selling fewer than D prime 1 units? So if you're down here and you have very low demand, what that means is that your costs are higher than your revenue. And if costs are higher than revenue, you don't have profit, you actually have loss. And so there's the first break-even point, which identifies at what point you're beginning to earn money, such that you have profits. And then the second break-even point, why is there a second break-even point? Let's think about this. What we're saying is that you're selling more and more units, but we see the revenue is going down. Even though we're selling more units, the reason why revenue is decreasing is because we had to lower the prices to stimulate that demand. And so if you have a low purchase price for the item, you're not getting as much revenue, but your costs are still high. The costs don't go down just because you're charging less for your item. It just means you're getting less revenue. And so this second break-even point represents the last amount of demand that will be profitable for you, and any more than that is not profitable. So the range of profitable demand is between D prime 1 and D prime 2. Anywhere in this range, your company will be profitable. But outside of that range, your company will be operating at a loss. So remember, D star is, when we were on that previous slide, we were looking at the formula for D star. That is the demand that generates the maximum profit. And so just graphically speaking, it is the point at which the revenue curve is parallel to the total cost curve. Because if you look at, these two curves are diverging. They're getting further apart. That means that the profit is still growing. But when the two curves are parallel, that means that this line is as big as it's going to be. The profit line is as big as it's going to be. And then if we move to the right of that, those two lines are now getting closer together because they're no longer parallel. And so they're converging, which means the profits are decreasing. So that's the graphical solution to this. All right, let's practice this out. The in-class exercise, I sent you an email with the PDF file. I don't know if you had a chance to print that out. If not, that's okay. You can just work this on a separate piece of paper. We're going to go through the process of looking at what if a company is producing an electronic timing switch where we know the fixed costs, and so C sub F, fixed cost $73,000 a month. Variable cost per unit is $83, and so that's the lowercase v. And then we have an equation for the selling price per unit. And so this equation is the relationship between price and demand. And so from this we can get the intercept, A, and the slope of the line, B. All right, so the questions that I'm asking, first of all, is determine the optimal demand for this product. So optimal demand is D star. So calculate D star. And then find out, if you're selling that many units, what will be your profit. So in other words, you need to find out for that amount of demand, what's the purchase price and what are your costs. And so profit is it's revenue minus cost. And then question C is asking what are the break-even points, and so you'll need to use this complicated break-even point formula. And then D is just to create a sketch that looks like this, that identifies the profit amount, the optimal demand, and the break-even points. All right, so I'm going to pause for a moment and give you a chance to try plugging these numbers into the formulas that are on the screen there. Solving for D star, finding the maximum profit amount, and then D prime, the domain of profitable demand. Of course, I'll break back in after I give you 5 or 6 minutes to begin your calculations. I'll break in and show you the solution. Alright, so on the screen you can see where I've identified the variables, and this is a good way to begin a problem, is with the information that's given, just kind of line that up with the variables that you know are going to have to be substituted into the equations. And so $180 is A, and the slope of that price demand curve, 0.02, is B. And it's not negative 0.02, it's just 0.02. The minus sign is in the equation, it's not assigned to the variable. And then the variable cost per unit is $83. So you can see that this company should try to sell 25 units. That's how many is going to ensure that they have the most profit. And so if that is the demand that they should be aiming for, then the question is, how much should they charge in order to cause that amount of demand? So remember, demand is a dependent variable. as a company, you can't force people to buy your product. What you can do is you can set an attractive price that then stimulates the demand that you want. So in part B, it's asking what's the maximum profit, and profit is revenue minus the costs. So the first thing we can do is we can find out what price should we charge. And in order to sell 2425 units, that means you should set the selling price for this timing switch at $131.50. So our market research tells us that if we charge $131.50, then based on the market, then we'll sell 2425 units. And like, how would you know that? You know, in a company, the accounting department, there may be a specialist who looks at previous selling history, the competition, what their purchase prices are, basically trying to identify across the entire market how many of the things need to be sold each month, and then looking at what the demand might be. One of my good friends who lives in Florida works for Universal Studios, and his job is to figure out what they should charge, what should they set as a ticket price at Universal Studios. And so he kind of does experiments to investigate what will be the park attendance with different promotions that essentially offsets the purchase price of the tickets. So there are people who specialize in figuring out this equation. So we should charge $131.50. So if that is our demand amount and that is the price, then that means the company's revenue will be $318,887.50. That's revenue. And then the formula that's up above says that profit is revenue minus cost. And so we also have to know what are going to be our costs if we're generating that many units per month. And so remember, cost has two components. It's got the fixed cost component and the variable cost component. So our cost is going to be fixed plus variable. So it's the $73,000 a month plus $83 per unit, and we're selling 2425 units. So that means our costs each month would be $274,275. So then the profit is just the difference between the two. So this is a pretty good business, I guess. I wouldn't mind getting $44,000 a month in profits. This is for the whole company. All right, so the in-class exercise was asking what is the maximum profit. So we've calculated that. Now the volumes at which break-even occur, the range of demand using this formula for D prime. Let me show you what that looks like. All right, so here's our equation. Okay, so if you substitute in all the information that we've got, there's a plus and minus in that equation, which means that to find the two different values, at one point we're going to add that bracketed number, and at one point we're going to subtract what's in that bracket. And so what we should get is that the range of demand is 932 units is the first break-even point. And by the way, I think it was maybe a fraction, like a decimal, and we have to round up. It, like for example, if you solve for it and it's 931.7, well, 931 would not be profitable, so you have to round up to 932. And likewise with 3918, maybe it was 3918.5. You can't sell a fractional unit. You either have to sell 3918 or 3919. And you wouldn't round up because then that would be beyond what's profitable. So 3918 is the last number of units that's profitable. So if we create a figure that just kind of illustrates that, let me zoom in a little bit so you can see. I've just put the typical curve where we have this parabolic shape, and then our total cost curve, which has an intercept that corresponds to the fixed costs, And then the increasing slope of the line corresponds to our variable costs. And so I've identified the D star, which is maximum profit. I've identified the first break-even point of 932 and our final break-even point of 3918. All right, it's 12:49. That's all the time we have for today. If we just look at these announcements again, then I'll remind you that homework 11 is due a week from today, but since we've just gone through this in-class exercise that directly addresses the first two questions, I'm going to suggest it'd be a really good idea just tackle the first couple of problems on that assignment now while it's still fresh in your mind. The other thing that you should be thinking of is the project, which is due next Friday. And so if you have any questions about the project, any questions about the homework or the exam, just feel free to get in touch. We can set up a conference call, or we can try and address it via email, but just let me know if there's anything I can do to help you. Otherwise, have a great day, and I'll see you in class on Friday.